When you tap to book an Uber, it feels simple, but behind the scenes, a massive business engine is at work. Ever wonder how that translates into dollars? Let's break down Uber's financial story to see if it's driving toward a smart investment. Uber's revenue has been climbing steadily, growing 18% in 2024. But despite this, they've had net losses until recently. Revenue has been strong since 2017, except for when COVID hit in 2020. Their core cost to run the business is high. They've also had other high operating costs like R&D. That left their net profit to be negative. But in 2024, it became positive, showing it reached profitability. But investors like you and I need to monitor this and see if they can sustain positive. Uber's gross profit margin is 33%, which is decent but lower than competitors like DoorDash, which is at 49%. However, Uber's operating income is at 6% right now, much higher than DoorDash's, which is less than half of 1%. So what does this show? Uber's more efficient at managing its operating costs like rent and employee salaries. Uber has solid cash reserves and a reasonable debt to equity ratio of 1.5, which is not concerning. Its operating cash flow turned positive in 2022, which is a huge improvement. Its free cash flow has been positive for 4 years, which means Uber has cash left after paying all of its bills. That's great news for growth or potential dividends. In terms of valuation, Uber stock is pricier than most. Its PE ratio is about 22 times higher than the industry average, meaning investors are paying a premium for future growth. Uber's growth is outpacing the industry significantly. Its revenue grew almost 18% last year compared to the industry's 3.8%. Its EBITDA grew almost 83%. That's way ahead of its sector, which is sitting at 6.1%. Its EPS growth was 422% last year. That's over 100x faster than the industry. Its explosive growth could justify why investors are willing to pay 21 times higher than the average industry stock for Uber. Uber's profitability is improving. Gross margin is 33%. That's a good sign. Its EBITDA margin is 8%, but a margin of 10% is what I consider healthy. Investors will be monitoring this. Its net income margin is 22%. That's far above the sector. Its ROE is 60%. That's a great return on equity. The key takeaway is Uber is becoming more profitable, but it still needs to improve its operating efficiency. So, what's the verdict? Should you invest? Uber is a high growth stock with a premium price tag. For growth investors, Uber's rapid expansion makes it attractive. For my value investors, the high valuation is a concern unless the growth keeps up. For profitability seekers, hey, it's improving, but there's work to do for Uber. Overall, Uber is promising, but make sure you're comfortable with the high price and need for better margins. If you want a deeper dive into Uber's financials, I've put together a PDF for you to download to help you decide if Uber belongs in your portfolio. Thanks, and be sure to subscribe for more.